recommendation is to see data, listen to the top honkos commentary very carefully, and then try to come to a fair conclusion in terms of which direction the economy is headed and which direction we should head in terms of our portfolio. So if you look at Indian economy, right, the big picture where I keep telling, and this is one such data we keep referring every 90 day, where when the results come out, right, the CEOs or MDs do come into the conference call and speak about the broad economy and the company strategy and the execution. So this is a commentary from SBI con call, where they start with global growth remains resilient with easing inflationary pressure. But interestingly, IMF upgraded world growth from 3 now to 3.2 from 2.9, which is much better, right? In terms of growth accelerated 30 basis in the last 6 months, IMF upgraded. If you look at for India, right, the conditions, however, are shaping up upliftment of real GDP growth backed by strong investment demand and upbeat business and consumer sentiment, right? So clearly a very strong commentary coming out of the largest bank out of India, which is State Bank of India. If you look at L&T, right, again, a behemoth part of a Nifty index, a very large company representing infrastructure, right? And despite the global headwind, the Indian economy continued to present a picture of resilience and momentum. Urban consumption spends remain very strong. The buoyancy reflected in various high-frequency economic indicators only reconfirm the country's growth momentum, right? So I think both SBI and L&T, right, one common thread, right, is economy is in a great shape. I think the behemoth have called out, and I think it's very explicit, right, in terms of how and why this growth can be for very long is the fundamentals of Indian economy remain solid, with both corporate and bank balance sheet is in extremely good position, right? So I think in next 5 to 10 years, right, the growth can be very long because of the two core pillar for long-term growth, which is banking institution, which can lend money to the companies, is in an extremely healthy position. Companies, which is going to put up plant and produce products and sell well, also in a healthy position. So I think both the health in terms of balance sheet is extremely pristine as we speak. If you look at exports, I think exports been a challenge, but that is going to be the opportunity in next 2 to 3 years, right? And if you look at Bajaj Auto, primarily being one of the very large exporter of two-wheeler, calling out export has 3 types of market: a stressed market, neutral market, and a new market. So typically, stressed markets are Nigeria, Bangladesh, Kenya, Egypt, and Argentina. Primarily, these markets have gone through high inflation and slight economic, slow growth, and obviously currency availability. I think these are the things which is getting hurt for a lot of exporters. Rural economy, if you see, interestingly, HUL finally called out that they are looking for a gradual recovery and hopeful for better monsoon. I think the next biggest catalyst for the market will be the monsoon. Most like the urban consumption continue to be resilient and premium consumption is very strong. So they've called out saying rural should stabilize and should come back. Urban consumption has been more resilient and premium is also doing very well. Now coming to the capex, I think this is one sector being the darling of the market. Those who have invested in a couple of our portfolio, right? We were very early into this theme 4 years back and really captured a lot of benefit. Not only having capex, which is on the capital goods side, we have a lot of industrial products which will benefit post the capex. And again, right, a very strong commentary from ABB. What we are seeing is a positive market momentum across the segment, right? A very healthy mix of a long cycle, short cycle projects are coming. Particularly very excited about data centers and the metros, right? So classical way of we seeing this big growth coming out of data center, metro, airport, everything getting reflected in a lot of capital goods, right? And energy transition is another big theme. So if you look at all the commentary, right, either very positive or where like exports and rural, which has been a soft patch, but I think it is now well within the base. So I think in next 2 to 3 years, one natural extension is I think rural should come back very well with, I think this mandate government will focus little more on rural. And export naturally, I think last 2 years been pretty muted, and the base is going to support for a lot of companies which is going to export out of India. So having spoken about the mega trend, having spoken about the commentary which is pretty positive, now let's see is the numbers, how numbers have come. the challenges in the number, and how we are looking at this number and trying to construct a portfolio on thinking, correct? So the first thing is sales. If you look at sales, the broad aggregate sales for the BSE 500 is 144 lakh crore, right? So you have an understanding, Indian economy is close to 330 lakh crore. Overall sales of the corporate BSE 500 companies, 144 lakh crores, which has grown close to 7%. Obviously, if you see, a lot of company had a margin tailwind, which is coming from raw material price gone down. So their sales volume growth was better than the price realization. That is why aggregately you saw 7%. But interestingly, if you dissect this entire 7% into large, mid, and small cap, large caps have grown at 9%. Primarily banks, oil and gas did extremely well. Mid caps at 6%. Small caps at 0%. But obviously, the data is slightly aberrated because few of the sectors like chemical, predominant representation comes out of, right? So if you remove couple of sectors, even small cap stocks have done well, at least under pockets, which we will see in the subsequent slide. But one myth is small cap tend to grow very fast and aggregate is a myth. Definitely in pockets of company, pockets of sector, small cap do very well. But in aggregate, I think they also tend to grow very close to what the broad economic growth happening. So if you look at the sales by sub-segment, crude oil, which is the largest, right, which is a big swing factor, hardly grew or 3%. But banking did extremely well. We saw a lot of banks reported extreme healthy numbers. The limelight of this year, this quarter is automobile. I think automobile has come back pretty strongly. I think as we speak, there is a very likely chance Hyundai will be filing their IPO with SEBI in some time during the week. So we are going to get a lot more companies available for investors to invest in the medium term, right? Starting from Maruti, Hyundai, Mahindra, who's a champion in SUV. And obviously, right, Tata Motors also is going to go for a demerger with passenger vehicle as a separate company, right? So a lot more very interesting times in terms of auto. They have come back very strongly, both OEM as well as the auto ancillary. Iron and steel again, right? Any metal, oil and gas, sales is a function of unit volume and the price. I think unit volume was good. Price realization was a little different. That's why it's muted. If you look at infrastructure, another very bright spot, did extremely well, right? I think the entire government thrust on infrastructure is reflected here, right? Growing at 19%. The context is when the entire corporate has grown at 17, infrastructure companies are growing at 2.5 times. That is where the entire excitement is reasonably real. But obviously, in some places, it's get overpriced. One sector where clearly the pain point is severe and continue is chemicals. Chemical represent close to 4 lakh crores, which has gone down by 50,000 crores, very primarily from exports and a lot of things. Otherwise, broadly, the cyclicals did extremely well from a growth point. If you look at in terms of shallow cyclicals, or I would say self-compounding, steady compounding industry like alcohol did well during last year. FMCG, very muted growth from sales. Again, if you remove in FMCG, volume growth was a little better than the price. Healthcare, decent growth, 9%. IT also muted. So it's a mix of markets where very stable companies have grown slightly less than the India. But with this growth coming back, the cyclical companies have done very well. So when you construct portfolio, today to gain momentum, you will be very high on cyclicals. But if you have to build a very medium-term durable portfolio, you should have a very good mix of cyclicals, but cyclicals also have run up sharply. There is a good opportunity window always was available in the shallow cyclicals or a very stable compounders like FMCG, which we generally allocated a lot more during last 1 year. And I think last 1 month turned out to be an extremely rewarding in terms of for the very attractive valuation, we were able to buy into company and now the prices have started moving up. Having seen the sales now, the story is in margin expansion and that's getting reflected in PAT. Sales grew at 7%, but if you look at PAT, grew at 26%. I think the one big takeaway for all our listeners, right, in terms of this year was a year of margin expansion and a fantastic in terms of close to BSE 500, 300 odd plus company had margin expansion. So it's a story of margin expansion. Many company experienced, many industry have experienced margin expansion. Again, right, large caps did extremely well, mid caps did extremely well, small cap, barring few industry, did very well. But aggregate picture, the entire earnings have grown 26. So that is where I would say this entire market rewarding is primarily coming from fundamentals. Obviously, there are pockets where the froth is getting built, no second thoughts. But is it the entire market is driven by flow and sentiment? Answer is no. Fundamentals are growing, and last 1 year, the entire aggregate profit pool has grown by 26%, which is a very, very healthy number. I think this is something which we should take back. If you look at last 1 year, primarily even markets, which is the broad markets, have delivered between 15-20. So broad markets have given very much in line with what the profit pool has grown. Obviously, in pockets, stocks have rallied 1x, 2x, 5x. There was one screen I was running in. The number of company trading more than 100 PE has hit historical high as we speak, right? So clearly, there are areas of froth, but otherwise, the broad market is doing extremely well, backed by the fundamentals. Again, I double click the entire profit pool into various sectors, subsegments. So if you look at, again, right, banks, which has actually still the show, 3.36 lakh crores, which is one of the highest profit pool generating segment. That's why I keep telling one next big leg up to the market will come from banking stock. They are available at an extremely reasonable valuation for a very long growth possibility. They have grown at 38%. Oil is a swing factor. They did very well during last 1 year. Automobile, right? I think the biggest, again, limelight is automobile. They have grown almost close to double the profit pool. We have seen a lot of auto stocks are hitting record highs, right? So I think the story of auto clearly reflecting the economy, which is Indian domestic economy doing very well, with banks in a pristine shape, auto doing very well, and hopefully FMCG will catch up in the medium term. Again, if you look at chemicals, as in the sales, you saw tremendous pressure. The profit pool has gone down from 37,000 crores aggregate to 24,000 crores. On the if you look at on the shallow cyclical segment, IT did a very soft growth, 7%. FMCG is zero, right? I think this is where the pain point. It's a 50,000 crores profit pool segment, a very stable segment. But I think last 1 year it was a very muted top line. And obviously, right, with advertisement expense going up and the infrastructure investment is going up, they hardly had any profit growth. But I think FY 25-26 should be better than what FY 24. Otherwise, if you look at, again, right, from profit pool point of view also, deep cyclicals did extremely well than the shallow cyclicals. This is one of our very favorite slide to see when we allocate capital, should you look at sector wise or should you look at stock wise, right? So one of the framework we refer is, if the sector itself is doing extremely well, being in the sector is more important than primarily which stock you're trying to drive. So if you look at capital goods, one segment in the last 4 years did extremely well. So getting into capital goods was more important call than what you buy into capital goods. Obviously, it can add little more value, but capital goods as a segment itself did extremely well in the last 4 years, right? And this is the same point we are trying to see which sector is doing extremely well at aggregate level. So let's take finance. 43 company in BSE 500, which is 498. One company numbers are not come out. One company only one. It was only listed in FY 24. So 23 numbers are not there. So once you remove these two, it is 498 is a number which we have aggregated. Out of 43, 30 odd companies have grown profit more than 20%, right? Clearly reflecting a very good portion of the companies have delivered good numbers. So that's why the ratio, if you look at high growth, which where I clubbed 10 to 20%, 20 and above, which is 31 in finance, and 12, which is slow growth, right? So if you put this metric, it is 2.58. What does it refer is, for every one slow growth company, there is 2.58 times of a high growth company available in this segment. So I think having a position here is more important, right? So if you look at the opposite, chemicals, 42 company, 0.4 is the number, reflecting for every one company which did badly, only 0.4 company did extremely well, right? So it was actually a sector issue. A lot of companies did very badly. 29 out of 42 company reported negative PAT growth, right? Really reflecting it's a sector pain point. So So if you look at the segments which did well, finance did extremely well, banks did extremely well, iron and steel did very well, infrastructure, right? Three, clearly out of 12, six company grew profit more than 20%, right? So I think clearly reflecting in some pockets, it is a sector specific. But if you look at pockets like an IT, 1.38 or a healthcare 1.25, it means what does this tell is from an allocator of capital, the sector has wide variety of outcomes. So in healthcare, out of 45, we have 24 company did extremely well. At the same time, 14 odd company did pretty bad in terms of operating numbers. So you have two polar in terms of you have a performing companies and you have a non-performing company, right? So here, stock specific will become very interesting rather than taking a sectoral call. So healthcare did a pretty, broad-based. IT is also very similar. Out of 31, 12 company did extremely well. And if you look at IT, predominantly 0 to 10% had 9 companies. But aggregate picture, if you see 1.25, again reflecting there are more company which is growing better than the company which is slow growing, right? That is where the opportunity lies for all of us. And these are the 43 sectors which has been given by BSE 500. So last slide, which is from our own making, and obviously, right, I have a couple of slides from the institution. This is one of our metric keep thinking about is the 498. We do this diagonal in terms of sales growth, division, PAT growth, right? So I'll take one number and brief it for those who have attended for the first time. 85 number, if you see, right, which is close to the right end. These are the company which has grown the top line 20% and the bottom line 20%, right? So significantly, sought after company by every investor. But definitely, this is not a stock today you buy because everybody knows the numbers are good. It is actually could be overvalued, right? So close to 182 odd companies, which is marked in a grayish color, is where the growth of operating sales and the profit is very, very common. It means there is no pain point. They are doing much better than the country, right? So hopefully a very good portion of our investment stock should be falling in this. But at the same time, opportunity set do come in a pockets where the numbers are not today and maybe eventually they become better. So let's take the number 74, which is on the left top. These are 74 company where sales has not grown, neither profit, right? Obviously, these companies have not participated in this bull market. Predominantly, they are down. So one of the questions keep coming up to us is market has overvalued? Is there any opportunity? I think there is enough opportunities there. The question is which segment you are trying to buy in today to deliver sustainable value in the medium term, which is 3 to 5 years. So I think the numbers are giving us the window. There are pockets of the sectors are doing extremely well, and there are pockets of sectors are not doing well. Our opportunity is to invest into sectors which can do well in next 3 to 4 years, or invest into stocks which is coming out of the pain and actually will have better times in the next 3 years, and the valuation is reasonable. Last before data on the numbers, this is further split by Avendas has done a fantastic work. I thought I'll just share one of the data here is how every sector, large, mid, and small cap, have grown in revenue, profit, and employee cost and other. So I'll take one example. Obviously, right, we will put out this video. You can see this, and if you need be also, we can share the presentation. If you look at large capital goods, a very interesting segment did extremely well. Capital goods, all the three, large cap, mid cap, small cap, grew the revenue at a very healthy rate, right? So large cap grew at 18%, mid cap grew at 11%, small cap grew at 18% again, right? So revenue has been very solid. So one data, what I want you to see is employee cost, because how operating leverage. So question of why margin expansion came is operating leverage kicked in. When the growth comes back strongly, you will use your fixed cost very efficiently. And I think capital goods have displayed brilliantly, right? So large cap, which say revenue grew by 18%. If you see 1, 2, 3, 4, 5, sixth column, where the employee cost is grew only 9%. So sales growing at 18%, employee cost growing 9%, right? Which clearly reflects operating leverage at employee level. And that is what flew down to PBT, and post-tax, it flew to the MAT margins. And if you even look at other expense grew at 14%, which is much lesser than the top line. So whenever a company does top line growth, very healthy, right? Operating leverage will kick in, and that is what happened to corporate India for multiple segments. And as I told, this is another data again, margin expansion. If you look at capital goods, which is on the top fifth sector, as a sector itself, 3% operating margin came up in the last quarter. Interestingly, every segment, large cap, mid cap, small cap, every segment had margin expansion. Again, reflecting this, right? So last entire 1 year, to someone substantive, is a growth of 7 to 8% aggregate. Few sectors did very well, few was very soft, but it is all about margin expansion, led to a very healthy profit growth of 25% plus. So having seen the mega trend, having seen the commentary, third, having seen how corporate India performed, right? Hope this gives you confidence about how much ever we are there, right? In terms of next 2 to 3 years visibility, this gives you a very good construct. We are in a very healthy wicket to stay put, keep compounding money at a very healthy rate. Going to subsegments, which is basically on the sector, as I told, banking did very well. One of the very big thing is growth continued to be very strong in banking, primarily a 14-15% growth, led by private from HDFC, Kotak, and ICICI Bank. So if you see in couple of our portfolio, right, we are very overweight because they continue to gain market share over the entire system. If you look at credit to deposit ratio, which has been a pain point, now stabilizing, which is a very good news in the medium term. And if you look at the growth, where the growth is coming, agri is very stable to upward, industry growth is stable, service growth is stable. The growth which is slightly slipping is retail, and understandably where RBI also wants to slow down. Within the banking, the segments which is doing extremely well is housing. Housing growth is close to 35-36%. One segment or two segment where the growth is slowing down, one is credit card and one is other personal. Again, primarily from the direction from the regulator to slow down, to be more measured in terms of growth. Why we say this entire economic growth going to be long enough is the position of the banks, right? And this one data will clearly bring out how much capital people have in terms of, right, very, very significant. So the average requirement of a capital of 3.5% in terms of leverage. Today, if you see Kotak Bank, HDFC Bank, or all the private banks, right, has 3 times, 2.5 times more than what is needed. Clearly reflecting our banks are well capitalized to support economic growth, not for 1 year, 2 year, at least for the next 6 to 7 years, right? This is one good opportunity where the entire lending machine is supremely prepared to support the economy. And the big concern on the banking will go away. And this is one data point I keep referring and I keep telling, right, when we take decision, you have to take decision based on high quality data. What this chart tells you is, if you look at every company against, you have something on the green or the red, right? So green reflects the finance cost is actually going down. And if you see in a lot of companies, suddenly green started appearing, which is reflecting that finally spreads are stabilizing and slightly moving upward. So the issue of spreads are stabilizing, or it's a mixed bag, right? So it is not spreads are completely compressing for all the companies. Coming to banking did very well. Coming to FMCG, as I told, last year been a pain point and couple of names to see, right? So if you look at annual trend, typically FMCG company tend to grow 8 to 9%, but last 1 year been a pretty slow patch. HUL grew at 2%, ITC nil. Nestle, it was a 15-month reporting, otherwise it was a close to a 13-14% odd growth. Britannia 2, Marico negative. So primarily, if you see, not many companies did extremely well. Colgate, interestingly, did very well, not from volume growth. Colgate actually truly a brand company, and they've used the brand advantage to raise prices of the product, which led to the growth of the company. So again, if you see Colgate volume growth is only 2% vis-a-vis the overall, right? The best volume growth came from ITC and Godrej Consumer. After a long time, Godrej coming back in multiple business division. But otherwise, this FMCG, it's not one company, two company. The story remains almost all the company reported a muted growth, primarily from rural India. I think next 2 to 3 years will be where the growth will likely to pick up. Very similar story in IT. I think very muted growth has been a pain point for the larger company. where TCS and HCL did reasonably okayish, even though it's a 5%. But these are global company from the business model point of view. So global growth is close to 2% to 2.5 to 3%. So when a 3% global growth, this company tend to do 4 to 5, obviously, right? They're gaining some market share. Wipro and TechM had a very disappointing. TechM is going for a big turnaround. Hopefully, in the medium term, they should be able to display. Interestingly, couple of small and mid-cap company did well, like Coforge, Persistent, and Cyient did very well from the revenue and the operating numbers point of view. Auto, I think, still the show. I think the entire show belongs to Auto. I think every company actually reported very good. Margin expansion has been the story, and particularly if you look at the commentary, right, broadly, the next 1 year, two-wheelers is going to do pretty well, close to a double-digit growth. And if you look at passenger vehicle, did extremely well for last 2 years. So I think mid-single-digit volume growth, and obviously, right, we are buying larger cars. So I think top-line growth should be better, but I think volume growth should be 5 to 6. MHAV will be a little muted because of, I think, the first quarter due to election, it was been pretty muted. But broadly, if you see by FY24 numbers, it's been a pretty very good show. And I think across the board, every company did very well, right? Couple of interesting data from a trend point. We spoke about the sectors. This is big data in terms of how what is changing, right? From a medium term positive is if you look at India's position in terms of the GDP ranking, we were 13 in year 2000. We were in 13 in FY 2005 also. Then we moved to 10th. Then we moved it to 7th. And currently we are in 23, we were at 5th. And we are going to get into the journey of 3, right? So the 5th to 3rd is a journey which will put us into a very, very, I want to say, a respectable top 3, right? I think every investor who is coming today with a 5 to 7 year outlook, we're going to experience a transition where our economy will become part of top 3 in the world, will be looked after for many other industry. And I think that is a big opportunity who coming today and investing for next 5 to 6 years. This is one of the very interesting slide from L&T, right? I had told they spoke, but I think this is one great slide to represent, well positioned to ride the capex cycle. I think with all these big things coming out on energy transition, defense, data center, and finally even real estate is up, right? So I think corporate presentation commentary been pretty positive. Very strong demand from deposit. This is from SBI, primarily from GST, right? We have been seeing the entire government revenue is being kicking in and is hitting all-time high. Another data which I spoke in the commentary is the GDP growth, which up from 2.9 to 3.2. I think the data to support, right? So again, pretty strong commentary. The other bigger trends from a medium term, which we are trying to capture in our portfolio is in terms of the income levels going up. So one of the things which keep coming up is India is a 3,000 odd in terms of per capita, right? How does growth is going to flourish? But I think India is not one India, right? So there's a very interesting data where if you see at state level, at city level, the per capita is significant, right? So Mumbai per capita is close to 14 to 15,000, right? Dollars, which is far significant. And if you look at Chennai, which is 6,500, where I belong to, right? So clearly, a lot of cities are close to this 8 to 10,000, which will reflect what India is going to be in next 10 years, where the tier 2, tier 3 cities going to represent what today a typical Bangalore, Chennai, Hyderabad, and Delhi and Bombay are representing. And if you look at the number of people experienced, this is slightly dated, but obviously, right, the numbers did not change dramatically, except maybe DMAT. If you look at credit card users, close to 9 million. If you look at income tax filers, a mutual fund, right, 40 million. And completed one foreign trip is only 26, right? I think we have hardly touched the surface in terms of what the size of the economy and what number of people are experiencing it. So I think the next 5 to 10 years, the journey is more and more people will experience all these things, and that is where the opportunity going to lie from a medium term point of view. Very interesting, again, one perspective on the bullish note given by Mahendra. Day before yesterday, they put out this PPT on when 2047, when 30 trillion economy India will reach, right? The biggest 3 drivers going to be manufacturing, which is going to increase 16 times from here, right? Which is going to be the biggest opportunity for the next couple of decades. Then the third one, inclusive growth. I think women participation is going to be a major driving force. So I think there are many opportunities are going to open up incrementally when India will become from a 4 trillion economy to a 30 trillion economy, right? This incremental 26 trillion will bring its own opportunity, and that is where our portfolio direction should be ideally placed. One very particular trend in terms of products. So one of the very interesting thing happening in the last 3-4 years is there are sub-segments of the FMCG or other sectors where it's growing very fast. Like if you look at passenger vehicle, SUV has become a very strong segment out of the entire passenger vehicle, right? They are growing at 3 times, 4 times better than the aggregate. Very similar opportunities getting presented in small names. Like if you look at sunscreen, lotion growing at 77% CAGR, right? So from an allocator point of view, it's very important. When we see big picture, we also have to mindful. There could be obviously pockets of the segment within the big picture can grow much better. And that is where we tend to allocate capital, right? And this is one such evidence in terms of how within FMCG, which is doing extremely weak, there are pockets of FMCG products are doing extremely well, right? Which could be sunscreen or serums, or if you look at hair oil, right? Hair oil is evolving. People used to buy a plain hair oil. Now they're trying to see how best they can nourish their entire scalp, right? So there are a lot of interesting opportunity get presented. Even the listed companies are actually transforming into the similar segments. This is again very interesting in terms of how we have been very positive as a house in tourism. And I think no better picture than this, right? In terms of how India is a land of opportunity. We are perfect for a tourism because we are fully covered by water. We have a hill station. I think we have a mixed weather. I think a very good combination for a very vibrant tourist activity. On top of it, with the entire airports coming up in various cities, right? This is going to be one of the very, very interesting space to invest in the next 5-10 years journey. And we all want to travel, right? Post-COVID, I think we have seen extreme resurgence of going out. So having shared a lot of data in terms of where the positivity, now let's get into the numbers. I think to end, our earnings coming through very well. So this is a second year consistently, our EPS estimate is revised upward. So if you have to look at for FY24, the broad EPS estimate to start with was 917 rupee. Today we are ended at close to 989, clearly reflecting economy in a good shape, reflecting in corporate India, and that's where EPS is getting estimated, right? For the next year, which is FY24-25, EPS is expected to be 1092, again revised upward. And for FY26, it's 1248. Very clearly, very stable earnings. I think stable and upward earnings is a fantastic recipe to compound capital at a decent rate. But having said all, I think the challenge lies with the valuation. We are into a mid of a 3-year bull run with a very shallow correction here and there. So I think barring large cap and barring selective pockets, valuation is being stretched. I think another data to support Nifty is reasonably valued given the strong balance sheet of corporate, strong balance sheet of banking, growth visibility for the 5-10 years. I think paying a premium of 5-10% is not a big thing. So large caps are reasonably valued. The challenge lies in the mid and small cap. At least we see definitely pockets of segments have been very, very frothy. So this is a very interesting data from Kotak where typically small cap, which is in the gray shade, tend to trade 30 to 40% discount to large cap. And we saw whenever that excess happened, it gave to a correction in the medium term. So if you see Jan 2018, right, where small cap peaked and had a correction for 2 years, basically the discount narrowed to close to zero. And eventually, once the correction settled, the discount again came back to 35%, right? So if you see today, close to a lot of small caps are actually trading at aggregate level. Small caps and the mid and small large caps are either neutral or slightly premium, which is where I think in the medium term, even though economy is in a good shape, we are going to have a bipolar outcomes where portfolio with reasonable growth and reasonable valuation can do far better than pockets of portfolio which is taken all the growth and next 4 years growth into the valuation. And story looks very solid today, but I think next 2 to 3 years, the stocks might not do very well from a returns point of view. To conclude, economy is in a great shape, corporate is in a supremely good shape. Valuations is a challenge, and that's where the way we think and operate is we are consistently taking decision, keeping 4-year outlook with a reasonable return expectation, which is roughly 13 to 15%, right? The long-term returns, as I shared, India has delivered 10 to 12. I think anyone who's coming today with a 4-year outlook, having 12 to 15 is a reasonable expectation. Last year has been fantastic. We loved it, but I think repeat that will become very difficult because the starting point of valuation is extremely challenging. We're happy to report our performance of the 4 flagship products: Solitaire, which is our multi-cap; True Blue, large cap; Vriddhi, small and mid cap; and Spear, which is multi-asset. We have a fantastic track record on all the 4 products in the long term. And our endeavor is to take a low risk in the portfolio and try to deliver sustainable value in the medium term. With that, thanks for your time. We'll be happy to answer any questions. Thank you. Over to you, Tarun.
So the few questions have been posted on the chat.
Just give me 1 minute. So there is only one question, Tarun, or is it many?
Yes, sir, there's only one question. Sorry.
Okay. I think we'll just wait for 2-3 minutes. Let a few questions come out. So, okay, so far there is only one question. So let me answer that first. Good morning. What's your view on defense and railway stock near 3 to 5 years? I think let's talk defense first. I think finally the sector is picking up, undoubtedly a very, very strong outlook in terms of coming out from all the company. Primarily it's been primarily a policy driven decision to do a lot more inward. We are seeing a lot of growth coming. But the challenge today is we were just looking at a couple of names which is trading close to like 100, 200 PE, all right. And these are business where we have to understand, obviously they are high capable product, but the client segmentation is very few, primarily from defense, from India, and maybe few companies do export. They are balance sheet heavy business. Most of them doesn't produce a lot of free cash flow, right? So even though they have growth, the growth doesn't come without capital, right? It needs capital. So if you tie both growth and capital from a valuation point, it's become pretty challenge. But I think from a growth alone, it's very exciting. But we don't have any large exposure currently in defense. We continue to study a lot more company. But I think the challenge lies in valuation. Challenge lies in few of the business model are inherently very capital intensive and not a high free cash flow. On the railway, very similar in terms of see again, right? These are policy driven growth, but again, these are well documented. It's definitely in momentum. So yesterday alone, I saw almost every segment. The top performer was a defense stock, right? So I think people are talking a lot more. But I think execution challenges do come. We do get challenges as they execute. So I think valuations are completely not in favor of anybody seeking margin of safety. So we are not having any exposure currently in any railway stocks also. We have a proxy play which produce a lot of industrial product to railway, so which is a very high quality MNC company trying to capture that growth. We do have that type of an exposure, but we don't have very direct pure play into these both segments. What's the outlook on small banks like CASB? I think CSB we don't own, so no specific on this stocks. So, but broadly, banking segment is in a good position. So we don't track this company, so I don't want to comment on this. With not thumb being mandate for MDA trust, which they wanted to give ideally to infra might come down. Are you still bullish on infra? I think definitely they're going to take a slightly balanced view. This is what I think market is reading in. But infra is a primary driver, right? So if you take metro, typically a kilometer of a metro costs 300 to 400 crores. But once you put out metro, right, I'm sure it saves a lot of time, energy of people, which is a productive asset, right? So I think infrastructure is a very great way, one, to distribute money to a lot more people, because to construct infra, you need a lot of human resource. And eventually, once the infrastructure is constructed, right, the productivity of the society and the economy goes up, which is extremely good from a medium term growth. Again, you have to be very specific on which stock, which one. I think all this segment, which is the defense, railway, infra, is a theme of last 3 years where valuations turned very today not attractive. Very clearly, a lot more stocks are very. If I say a couple of names in our portfolio or where we are tracking, the forward 2 year, 1 year return is close to zero, right? Clearly reflecting a lot of this growth is well documented and it's priced into the stock. But I think in the medium term, if you have a 4 to 5 year outlook, definitely we have to find ways and means to buy into names when the present opportunity is presented. Like other day, where market felt disappointed beginning and it fell. We had a fantastic window for 1 hour. We deployed very good amount of money for our investors. And I think like that, when the market presents the opportunity, you should buy not today and tomorrow when market generally tend to go up, right? Is it good time for lump sum in mutual fund? I think it's a question of which segment of mutual fund you should invest, sir. I think, but otherwise, every time is a good time provided you come with a two framework, one time horizon. Definitely come with a 4 to 5 year time horizon and come into a fund which is well advised by our advisor. Our team will definitely will suggest you have reasonable return expectation close to 13 to 15. I think you should be in a good wicket. What are the best sectors for 1 year outlook? So I think best sector. So we are primarily positive on few consumption stories which have not done anything in the last 3 years, where they are market leader. Their mind share is close to 90%. Market share is about 25%. So clearly a dominant player in a weak market environment from demand point. So we are buying into names like that, and hopefully in the medium term, India being a big consumer economy, as the consumption comes back, we should be able to benefit. So our tilt is slightly towards consumption. We have been investing into consumption for quite some time. I think we are getting a little more aggressive there. Tilt is also to coming with companies in international or export, where a few of our companies or segments becoming a world champion in the particular business or particular segment, and with a lot of innovation coming out. So what COVID has done for a lot of companies in India is their innovation cycle has gone up, which is bringing a lot more new products with a high IP, which is going to propel the next leg of growth. So we are very positive there. We are neutral in a lot of domestic-led growth, because not from the growth point, from a valuation point. Hope I answered that question to you. What is the risk other than valuation, US election? Government stability, I think we in the past also had coalition government. Hopefully this government should be able to handle it well. But obviously it's a hope. We are not here to predict what will happen to the governments. These are bigger things. What our primary objective is control the controllable, right? I keep telling, we look at corporate data, you look at company specific, sector specific, buy into companies where valuations are reasonable, growth outlook is improving, ROE is improving, free cash flow is improving, and dividend payout is going to improve, right? So I think these are things which is controlled within our purview of framework. We look into that and invest in. And valuation, particularly in small cap, has been very frothy, mid cap, but in large cap, it is not risky, right? So I think, but we have to be mindful. Finally, an asset is worth its salt, right? So if you overpay it, you have to stay longer. That's a risk which we run in this market. And the expectation should be moderate, because last 3 years people have made good money. So the general belief is we making 20, 25 is an easy thing. It doesn't happen. The country is not growing at that rate. Corporate India is not growing at that rate. So any money you're making beyond corporate India's growth, which is primarily 13, 14%, it's going to be very difficult, right? So I think keeping our expectation moderate is going to help all of us. Hope that I answer your question now, Shilpa. We have stayed away from banking stocks solid with the valuation getting cheaper. I think, sir, if in solitaire, it is not an outlook on the bank, it's a strategy. The strategy of the product is very, very clear. Is a first India's first unique product where we said, if you look at hundreds of multi-cap in the country, 99 multi-cap fund has banking, right? So it means everybody has banking. Banking is a 35 to 40% exposure. So we thought we will bring a unique product without banking. So it brings two things to the investor. One, it brings a very differentiated portfolio because without a bank, so I have to invest within 60% your entire 100%, right? So that is a big, very differentiating portfolio you own by having Solitaire. Second, the portfolio quality become extremely pristine because banks are typically 6 to 10 times leverage industry, correct? We don't own any bank, any lending company. So the portfolio quality of Solitaire is far, far superior to any portfolio in the multi-cap in the country, right? I think with that construct is what it's a strategic call. I don't think anytime we're going to change that entire segmentation. And if you look at our outcomes, right, I've shared that data. We've done phenomenally well in the last 4.5 year period by taking 30% lower risk. Our performance is close to 8%, right? One of the country's best performing fund, I would say. But that's not our objective. Our objective is to deliver consistent, very long-term performance. So I think we're going to remain to be same. In the FMCG slide, it stated credit card user per million. Is that information accurate? The number appears to be quite low. No, the information is should be fine because it's been put out by one of the large listed company, and I think maybe it could be a slightly 1 year dated, but I think it should be fine, right? 85 million is 8 crore people, right? I think definitely that's a pretty large number. No PSU in Solitaire. However, they have given multi-bagger return in the past. Will there be a change in Solitaire view to include such opportunity? I think we had in past in the PSUs. It's not about our objective is not multi-baggers. We want to buy good, durable company by reasonable valuation compounded. I think we have done very well. We are not saying no to PSU or no to these things. Wherever I think the merit lies, Solitaire will invest. But the primary take of Solitaire is simple. Buy into very high quality franchisee with a great balance sheet, great free cash flow, good track record. So the business risk is very low. That is what one of the big question which we try to address out of Solitaire, and deliver a very sustainable value with a 30 to 40% lower risk. I think our objective is that. I think we are serving our objective. In a couple of other products, we do have a little more higher exposure to PSU. It's a question of what the product wants, but when the need comes, we will definitely invest, and we have invested in the past. Hope I answered your question, sir. Good morning. Is it time to book some profit due to overvaluation? I think it's a good question. Coming to our products, we are trimming positions which we initiated 2 years back. The stocks run up for 200% types where we think forward IRRs are low. We are trimming. So I think we will take that call. As we speak today, that's what no. If you are in a frothy segment, which I hope we are not predominant of our portfolio, not part of it. Fine. But if you have invested outside us and participated in zones which have become little frothy, I think you need to reconsider. But I think it's a question of what portfolio you carry. If I assume it's only Solitaire or portfolio from ithought, I think we are calibrating the risk low. We are exiting places where valuations have turned extremely sky high. And I think we will continue to take action where it is appropriate. You don't have to do. Will textile be contrarian call due to free trade? I think again, it's every segment. It's not only about contrarian, right? What type of a product you're trying to make and how much value you can derive over a long period is important. Definitely, textiles are beaten down. We are also working on a couple of names. We are trying to see how do we participate in a couple of names via either a branded company which is trying to capture the biggest change will happen in the entire economy where women share will go up, right? So we are trying to see and trying to capture, right? That's what I keep sharing this data is as an investment team. We continue to look at this data every day, see where the big trends are emerging, where a listed entity can provide us an opportunity to capture it, right? And we will do it. What is deemed fit. Please share your outlook on pharma. I think pharma outlook is pretty okayish to good. What has happened surprisingly in the last 1 year is US, which came back very strongly, and we saw a lot of our portfolio companies also did very well. But in the medium term, it's a question of India doing 8 to 9% IPM growth. We have very interesting company which will benefit out of heat wave. So we are trying to see how we can capture a lot of big um, trends again in the pharma. But I think pharma is always going to be a stable industry. But at least with our portfolio perspective, we have one of our company which is commissioning his largest capex in the lifetime. Hopefully, they're going to reward a lot more wealth to the shareholders in the medium term. So I think, but they are in a decent position. They never grow at a very high pace, neither they degrow, right? Because it's a basic necessity. It is given the necessity to keep the portfolio very stable. We have a very good exposure in pharma, 4 names particularly. What are you seeing in terms of big reforms government might undertake in next couple of years? I think they have taken very good reforms in the last few years, which I think they should continue. I think the big reform, possibly, right? I don't want to speculate because I look at policies and data dependent rather than thinking what they will do before they're doing it. But I think they definitely need reforms in little bit of documenting real estate types. Labor reform is expected in some or the other form. I think strengthening the existing reforms so well that the productivity will come. I think what they have, they should execute, which itself will actually propel the growth in the medium term. Presentation banks are reasonably well. I'm a customer of Solitaire, but I do not see any banks in my portfolio. Is it the same strategy for TrueBlue? No, sir. Every product has a different strategy. In Solitaire, we don't own banks by structure from the day one. We continue to do the same. But I think if you see in performance, I'm sure you'll be very happy and pleased. In TrueBlue, it has first mega large cap portfolio, which has the top 50 stock as a universe, which owns bank. We own a lot of banks there, reflecting the view. We do own banks in other portfolio. Even in Spear, we own banks. In other portfolios, we own. Right? Solitaire, just because of the structure, we don't own. Otherwise, we generally like banking. But in Solitaire, what you have to understand, we own a lot of wealth management, which is a mega trend. We own a lot of asset management, life insurance, general insurance, a lot of exchange. So I think we are capturing the financialization story in a very different format because we want to keep the leverage low. That's one of the primary objective of Solitaire, but still capturing the growth of finance in a non-banking companies, right? Hope I answered your question, sir. The client asked me this: why didn't your team spot the railway and different opportunity? If you did not, what deterred you from investing there? Okay, I think Tarun, in terms of, if you look at the track record 3 years back, if you just go take a 10-year data, see how they have grown, the free cash flow, what's an ROC. I think a lot of data was very mixed, right? So I think since the price have gone up, obviously, right, in hindsight, we could have taken 1 or 2 exposure, but we have played railway. We had Timken in the past, which played for railway bearings. So we played the cycle. We played in a very pseudo way rather than a very straight case way. But I think we are not here to capture everything. I think one of the things which we should also expect is there are close to 5,000 odd companies. There are various segments, right? Given the product requirement, given the product risk profile, we tend to choose names which suits the product. Obviously, we cannot capture everything. I think that's an honest answer. We are trying to learn. We are trying to strengthen our team. We are adding more team members to see we don't miss out opportunity repeatedly. But I think the expectation should be, as long as where we have invested did reasonably well and delivered what our promise is, I think we should be fine, and we continue to learn and evolve. We have a decent allocation insurance. I saw bad PAT numbers. How do you see? That's a precise point. Insurance PAT numbers are not right because insurance, we need to look at an embedded value, because when they sell insurance, all the expenses are getting to P&L today, but the revenue comes for 25, 30 years, right? So embedded value is a classic way. If you look at last 3 years, insurance company have performed very poorly, and that's where the opportunity, right? As you rightly observed, we see insurance is a 10, 20-year growth segment. Consistently will grow between 14 to 17%, which is 5% more than India GDP. Valuation is extremely reasonable. So in line with our philosophy, we are buying into segment of the market where growth for next decade is reasonably taken with India being a very saving economy and valuations are reasonable, right? So we're very consistent. You should be very surprised if today we end up buying a different stock, right? Because it can make all of us excited, but we are buying a froth, right? Or we are buying an overvalued segment. We are very will be disciplined our investing, and I think we continue to do that in all the funds. And that's where insurance has been a big part. We like both life and general insurance. I opted for Solitaire Vriddhi both the same time, but Vriddhi performance is far below Solitaire. Will Vriddhi performance will peak and given return? I think they both are very different objective. I think you have just come last after the same time last year. So I think one of the thing which I would request Basant Kumar sir is to look at product in their time horizon, right? So typically Solitaire time horizon to think about judging a performance is 3 to 4 years. We take decision on every single stock and the portfolio construct keeping a 4-year outlook. So when we take a 4-year outlook and for a very frothy market, we want to be a little more conservative, which is good to you in the long term, but might hurt you in the short term. I think we will take that decision, right? I think that's where for Vriddhi, it should be even more longer. Being a small and mid cap, you should look at close to 5 to 6 years time frame. Fantastically well built portfolio, great team. If you look at the long-term track record is outstanding, right? I think you need to give time and judging a product on a respective time will give you a very good idea. But I think in the long term, Vriddhi is expected to be little more higher return than Solitaire, given the risk profile of Vriddhi is little more higher, not because of quality of business, because of size of business. They do invest into a lot more small cap. It's a small and mid cap portfolio, unlike Solitaire, which is a multi cap portfolio. Any particular thematic fund do well in upcoming period? I think we don't have anything, but broadly, today it's question is which segment is under owned and valued reasonable, right? I think look for that segment and then steadily deploy capital in next 6 months. Once the growth slightly stabilize, which should happen in next 1 year as India is going to fiscally consolidate, I think of growth coming out, right? Which could be rural, which could be exports, which could be segment specific like insurance. I think they should pretty well in the medium term. I'm sorry. FIs have been selling over the last few years. The market seems to be propped by DRE. What condition do you think need to occur for FI to come back? I think FIs are one of the largest investor of India, right? So we cannot take away at a stock level. They continue to own a very large portion of India. But I think for them, the choice is multi-country and they don't have any compulsion to invest. I think given valuations in some pockets, they are taking that call. But I think they have been a big bull of the economy for last 20 years and I think they continue to stay. Obviously, once US rate goes down, that would be a big catalyst coming up where FIs can allocate more. The FIs might wait for their US elections to get over, see bigger picture on US and their policy towards various countries. And maybe our valuation also should give us some entry, right, at some point in time. So I think it's a mix of few factors, but I think they continue to be very positive. But I think in the near term, they're selling primarily due to opportunity elsewhere and obviously some bit of valuation stretched in some pockets. Hope I answered your question, Pratibha. Tarun, I think I've answered almost all the questions, right? We'll wait for another 2 minutes.
Yes.
Otherwise, we'll wind it. Is there any outlook on gold? I think we are very positive on gold as a house. We have been very positive for last couple of years, where typically if you look at most of the portfolio, we're underinvested, right? But in ithought, right, across the board, it could be MFD, it could be PMS, particularly our multi-asset product, which is PM, pretty bullish on gold and gold mining company and did very well, right? I think we see the macro risk of the world is little higher than what the long-term average. Definitely need a very good hedge, and the hedge against all this big risk is gold. And we own a lot of gold in all the portfolios where it is allowed to go. Otherwise, thanks for all for joining. Hope we added value in terms of sharing how corporate India has performed, how the big trends are. The final message is, I think India is in a great wicket. Corporate India is doing extremely well. Come with the medium-term outlook, 13-15% compounding with such a great economy should be a very desirable outcome, which is what we endeavor to do in multiple products. And we'll be very happy to serve you for your long-term needs. Thank you. Have a good day. Oh, sorry, last one. NASDAQ view. I think it's a global exposure. They continue to do very well. They've come back very strongly. Uh, yes, but obviously, right, that's one mega trend continue to happen for very long period. Thank you, sir. I think